Greetings from our team at Robare and Jones Wealth Management. This is Jack Jones, the managing partner, with our July monthly market update. Before we begin, we want to thank our clients for the trust and confidence that you place in us. The very best part of our day is time spent directly serving you. So we'll jump right into it. As always, a lot to cover. The first thing I'll mention is we hope to see many of you next week at our July quarterly investment forum. We're expecting about 100, and we look forward to diving into all of these issues in more detail. Would also like to welcome a new team member, Nick Dominguez, to our team. Joins us from A&M, and we're very much looking forward to him meeting you and being a valuable member of our team. So as it relates to markets, markets are up year to date, although still down from all-time highs in January of 22. One of the interesting characteristics of the market today is how narrow the growth is. So this represents year to date as of end of May. The percentage of S&P 500 stocks that are outperforming their benchmarks is only 28. You see how that compares to other years going back to 2007. So really the entirety of the market is being driven by only a few stocks. And what that means is those stocks are now very expensive. So the top 10 S&P 500 stocks are now trading at 29 times forward earnings, or 145% of historical average. So you're now seeing a very small group of stocks that are driving the market, and those stocks are now very expensive. So as it relates to recession, there's still a fairly high probability of a recession between now and May of next year. But you are seeing both the percentage of probability and the pushing back of the predicted recession till later. So we'll talk about this a little bit later, but something closer to a soft landing is more probable today, given events of the last week or two. So that's something that we're keeping a close eye on. As it relates to GDP, official GDP the last 4 quarters, including Q1, again, nothing spectacular, but still growth. We know the consumer drives 70% of the economy, so let's look at how the consumer is faring. Before we do that, though, as it relates to recession, this is how stocks do 3 months during and 1 and 3 years after. So kind of what this says is that most of the market damage takes place before a recession, and not during 1 year or 3 years after. So the jobs report was really good, this past week. Again, it's one of those where it's not so hot that the Fed has a lot more work to do, but it was still over 200,000 jobs added. 3.6 is the new unemployment rate, and the average hourly pay over a rolling 12 months is up 4.5%. So again, a good jobs report recently, again, not too hot. So the Fed has more work to do, but good job growth. Now that job growth is mixed in terms of how it relates to job openings. The job openings hit a new record in June over 2 million. So the overall employment picture remains a mixed bag, with a lot of job openings that aren't being filled. Now, in other parts of the economy, how the consumer is faring is relevant. You'll see debt service ratio as a percentage of household income has picked up. Part of this is due to the cost of money has now more expensive with interest rates going up. You also see delinquencies picking up. So this is delinquencies of 30 days or more in auto and credit card. And you see that starting to pick up. So there's some sign of weakness that's showing up with the consumer. More evidence of weakness is savings rate is way low. And we've gone from peak savings to now we're getting very close to that excess savings being burnt off. So again, some signs of weakness in the consumer to pay attention to. We got a really good CPI print. Most recently, the overall CPI year over year is down to 3%, with core that excludes energy at 4.8. So again, a pretty good print. A lower print was expected, but this was even lower than at 0.2% this last month, and annually 4, 8, and 3. Overall, a really good number. So this is what the Fed has been doing. That has contributed in part to inflation being lower. Is just a radical move in rates. 10 consecutive rate increases, with a pause most recently. We'll see what they do in July. Speculation is anywhere from a pause to a 25 basis point increase. But we're nearing the end of the Fed's interest rate increasing cycle. And this is what markets tend to look like after the Fed has their last interest rate hike in terms of bonds and stocks. So you see that as we look at history, on average, stocks up 20 and bonds up 11.5 after the Fed has raised interest rates for the last time. How much the Fed raises is key. So we see so far this year, they've raised 3 times for a 75 basis point cumulative increase. You see a much different picture if rates go up by more than 100 basis points in a calendar year versus less than 100 basis points. And so this is kind of worth keeping an eye on, whether we're at 125 basis point raise left, or whether we exceed that. The outcome set in terms of what assets are favored is dramatically different. Rates up less than 1% versus up 1% or more. So what's the outlook for the remainder of 2023? It'll be sunny unless it rains. So no one specifically knows, but here's some things that could go right, and evidenced by the data over the last few weeks. Inflation continues to moderate. Now, inflation is viewed 2 different ways. One is it's a lot lower, but we're still about 100 basis points above the Fed target. So, the inflation getting from 3 to 2 is still a big move, but it's clearly dramatically down from where we were in the summer of 22 at over 9%. A recession continues to be delayed, and if we have one, it's mild. So that's another thing that could go right. The other thing that we've started to see the last few weeks is the market performance has widened beyond the 8 to 10 tech stocks that are really driving the market now. And we see more employment reports like we saw recently, where they're neither too hot or too cold. Too hot meaning the Fed has work to do, or cold meaning there's a kind of an employment, less than 200,000 jobs added as an example, meaning the Fed has started to have an impact on the overall economy and the employment picture. So these are a few things that could go right, and evidence is over the last few weeks a higher probability of this for the back half of 2023. So all of this is no replacement to contact us directly about how all of these issues affect you personally. We welcome you to do that. Please leave no question unanswered. We're here to serve you. So with that in mind, we'll close. Again, we want to thank our value clients for the trust and confidence that you place in us. We look forward to seeing many of you next week at our quarterly investment forum. If you have any questions about anything discussed here today, please do not hesitate to give us a call. Until we see you again, be well and take care.